From Washington, this is the Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, July 22nd. You're listening to the Macrocast brought to you by Markets Policy Partners and Hamilton Place Strategies. I'm Tony Fratto with Hamilton Place Strategies, John Fagan and Brendan Walsh with Markets Policy Partners, and we have the great John Dick with us from CivicScience. We haven't done like big plugs for you, John, for CivicScience, and it's just occurred to me it's about time we do. Like, I don't know, people need to go and check out civicscience.com and see your stuff, because it's fantastic. The insights that you have on how people think about the world is really amazing.
That's kind of you. It's been a banner 2.5 years for us. I think and information is in premium value when the future is uncertain, and it has been very much that for the better part of the last 2.5 years. Not to revel in it, because it certainly been a lot of hardship for people, but it's when you're studying everything constantly like we do, you start to see things that others don't, and we're excited to share that with everyone. And I love doing it here too, because it particularly, I think it complements the broader global view you guys have of things really well. So thank you. That's very kind of you, Tom.
Absolutely. It's true. I mean, obviously a lot of our listeners are paying attention to markets and what firms are doing and what consumers are doing and what the government's doing. And we always benefit from your insights on that, not just when you're on the show. And then what you and I have worked on now for, I think, 11 years now, as we've said, is the Economic Sentiment Index, the ESI. So diving in on that, and obviously the macro impact of how people are feeling about their own personal economic situations, their personal finances, household economic activity, and then the world around them. We've seen now on the ESI 2 weeks of a little recovery in sentiment after a lot of a pretty sour period.
I mean, actually 4 weeks, right? Because what we put out publicly are 2-week readings, and obviously, behind the scenes, and our clients and such are getting the more real time in the weekly data. But this is when we've had sort of 1-2 week reading here and there that might bump up a little bit. We have not had 2 consecutive upward readings in as far back as I can remember. I mean, certainly probably 1.5 years or more. And the most recent one that we just published on, well, I guess it was Wednesday, was a very steep climb. So it's a little bit more than a blip, what we're seeing. And, back to kind of tooting our own horn a little bit, the real timeness of this, I think, is really important, because there's such a lag between Michigan and the Conference Board when they do their surveys and then when they report. And they're reporting, and of course they get headlines because they're such prominent indicators, but they're a month old by the time they hit the news. And I think this is a much more accurate sort of real-time view of how consumers are feeling right this minute. And look, we're still closer to the bottom than we are the top by a long stretch, but to have 4 straight weeks of positive readings it's kind of a big deal. I mean, I've been on this, on your podcast once a month throughout all of this, and oftentimes it's just more of the same. And this is notable.
John and Brendan, there's some other things we've seen in the last couple of weeks, which is maybe some topping off on some inflation data, which has dominated sentiment for a good while, and I think still will for a good while. But we also saw now 2 weeks of higher weekly claims. Not that they're very significant, but how are you feeling about where we think the U.S. economy is right now?
I'm definitely watching those claims closely, but they do have a hard time with seasonal adjustments in the summertime, especially because automakers usually put their people on furlough, and that changes from week to week. So I wouldn't build too much into the rise in it, but I do think it's worth monitoring that, the Fed is tightening. We do have some announcements, of either companies stopping or pulling back job off, listings, or actually laying people off. Some big companies too. But actually, the small businesses are kind of giving the opposite indication that they're still, having a hard time hiring it, but they want to. So I wouldn't freak out about the higher claims. It's still, 250 is still pretty low normal way to do it. And then on the inflation front, just kind of simply, so gas prices are down 11% from this point last month. And, in the CPI, gas prices make up 3.8% of the index. So when you multiply 11% by 3.8, that means that on the July CPI, just gasoline alone will subtract 0.4 percentage points from the number. So, core is a different story, but the headline number is going to be pretty low and maybe even negative for the July print on the month basis.
When you look at the improvement in the surveys, John, is that what Brendan's talking about? Is it the gasoline prices? Can you see where the improvement is coming from and what is lifting people's spirits up from the troughs of a month or a month plus ago?
Yeah, I mean, it certainly starts with gas prices because that's the easiest thing for the average consumer to kind of intellectualize because they either, they're filling their tank or they're driving by gas stations left and right and seeing the prices on the marquee, right? And sure, but I think it's a little reductive to say it's just about that. I think I think the consumer is generally feeling this sense that we maybe we've hit the bottom, that it's gotten as bad as it's going to get. Hopefully they're right. But that's the feel that they have. And even, even with the jobless claims numbers, which, when you read it, it's sort of, again, it's a headline grabbing thing, but they said, oh, this is the worst numbers we've had since April, right? So we're not not going back like years here. But the consumer's perception of the job market's still really strong. These quote layoffs.
That's such an interesting point. The disconnect,
Yeah, because I mean, the layoffs and hiring freezes, at least the ones that make the news, tend to be like the big tech companies and things.
That's really the big announcements have been almost entirely.
And that's such a small fraction of the job market, right? I mean, you're talking about like very high end people who by the way will find a job in 5 minutes if they want it. They're going to flush right through that sort of jobless claim period because there's so much demand for technology, engineering, marketing. Even in our company, we probably have 15 or 20 openings right now. I mean, it's taking us a long time to fill them, right? And for businesses like ours, maybe it takes a little bit of pressure off wages if people are kind of in the market. So that's good. That's good for that next level down below the Googles and Netflixes of the world. But I think the net's positive and the consumer's feeling that right now. And hopefully it sustains through, a couple more quarters.
The stock market also had 2 decent weeks that might help with sentiment also.
Yeah, and it is funny how weakness in economic data is being filtered through the lens of the market. We've got this new, what they call the Goldilocks is a balance in the market. The new Goldilocks is, weak, but not too weak. It used to be strong, but not too strong. But with the Fed on their mission to suppress inflation, the slowing U.S. economy is a feature, not a bug. And so investors are to some extent reassured by numbers that do show easing growth because they think, well, okay, this is getting us closer to a resolution, closer to the top of the Fed hiking cycle. The Fed is doing its job, and it'll take the sting out of inflation to some extent as we go forward, and we'll have a better balance in the macro landscape going forward.
Another really strong signal we see in our data is how surprisingly little credit card debt we are seeing from people right now, which we would, there's definitely seasonality to that. You see credit card debt spike in the summer and around Christmas time. In the summer, it's because people are, charging their vacation travel and such. So we would expect to see a little bit of a bump, but nothing more than that seasonality right now. I think, again, it's just a byproduct of, the 2/3 of the consumer marketplace that are still kind of spending off the fumes and exhaust of all that stockpiled savings they accrued throughout the early parts of the pandemic. So they're not putting things on the credit cards yet to the extent we're not seeing like a lot of like rise of buy now, pay later in retail, just things that we would view as like harbingers of of tough times to come, they're just not there yet. And we're looking, I'm almost like trying to find them, and they're not there. And again,
that's really important because it's also shown through the corporate earnings season. So today we just got American Express, which is both the high-end consumer, but also the corporate spend, and their sales were up 32% from a year earlier, and they're seeing the same. It's just a very strong consumer. They're also taking market share, so it partially a very good story just on American Express. But last week we had Synchrony Financial, which is the subprime credit card lender. And while they did, start to build some reserves for the future because of the tightening of the Fed, they're still seeing a lot of strength in their consumer book, but also they're not seeing people stretching to a worrying extent.
It is important to call out, though, that there's that bottom third of the income sort of pyramid that is feeling it a little bit harder than sort of that upper 2/3, and maybe more so than just a little. But what we're seeing there is just a shift in the spend. So there's a lot of options for the consumer today, right? They can move down market. They can move from say a Target down to maybe more of a discount retailer. They're one of the weird sort of blessings of all the supply chain disruptions we've had is that consumers have been conditioned over the last 2+ years to move away from some of the blue chip brands that say in the grocery store that they've bought year over year over year, and moved into like private label, which is actually putting some pressure on those kind of blue chip CPG companies a bit. But the consumer has some optionality in the market now that maybe they didn't think they had 2, 3, 5 years ago, and that's just easing it a bit even for them. Gas prices are what they are, and that's, I think, why that's the sort of the tip of the spear when we look at the entire kind of monolith of the consumer population lifting the sentiment of that sort of bottom third of the income spectrum.
Are you getting any signals, John, about back to school?
Yeah, I mean, intent seems to be strong. We're pretty bullish on. We get asked that all the time by retailers, and in fact, the retailers are already now asking about holiday because they're the ship sort of sailed for them on back to school because people, and this even predated COVID. People are shopping earlier and earlier for these big events than they used to, right? Black Friday is no longer, use Black Friday as a signal. Like people don't wait till the Friday after Thanksgiving to shop for the holidays anymore because the events start so much sooner. Prime Day we think is going to turn out to have been really strong. It's shifted a little bit because what we saw this year was a lot more people went to Prime Day with sort of explicit things they were going to shop for versus sort of like window shopping and impulse buying, which has happened a lot in the past. So there's a little bit less of that. But it was only, still, roughly about half of Prime Day shoppers bought something they didn't expect to buy when they got there. Right. So there's still, a lot of positive signal from the consumer. And that, I think that's going to lift us definitely through back to school. And I'm still pretty positive on holiday. Once we get maybe past next Christmas, who knows? But there's just still a lot of pent up cash in consumers' pockets right now, and yeah, maybe by holiday they'll start dipping into those credit cards a little bit more aggressively. But I'm still pretty bullish at least through back to school.
Yeah, it's hard to. I only think of it as sort of mixed, right? I mean, I definitely see that that the consumer has held up really well. Some of it is. There's in fact, I don't know if John or Brendan, if you guys have seen like good data just on breaking out, like how much of it is price, how much are we counting price rather than, sales of individual things or activity, economic actions that consumers are making. I mean, I know it's split, right? But some of this is, all of us are watching, we're watching TV and reading, and the sort of like freak out over the, expected outcomes of, Fed action or even higher prices. Like it tends to drive you nuts a little bit, right? I mean, it's like we just, every time I turn on the TV, I'm seeing a report on the slowing housing market, and it's presented like a freak out. And I always wonder like whether people are hearing it that way also, and does it cause them to freak out? And like, I don't know if anyone's freaking out at all. I just know that like when it's presented that way, that the Fed raised rates, housing cooled off. That was exactly the intended.
Yeah, because 6 months ago, the news was reporting that there's a housing shortage, we're in a bubble, and we need to slow it. So what do you think the Fed was intending to do?
We can't build more houses, right? Not without,
Yeah.
If you have we can, I guess, but no one wants to, or doesn't have the labor or the supplies to do it. So there's only one thing that you can do, and is to bring down demand, and that's exactly what's happening. And it's just and it doesn't have to be a complete freak out.
Look, if it bleeds, it leads, right? That's that's what and when again watching the consumers react, and they do react to that, of course, right? Because they're very susceptible to the headlines, and we all are to some extent. And I find we've talked a fair amount about this, Tony, is like how much of this is just like self-fulfilling prophecy. If everyone just keeps glooming and dooming, do we talk ourselves into it? Are these hiring freezes and layoffs by these big tech companies real, or are they jumping the shark a bit? Are they reacting to some potentially irrational fear about some uncertain outcome or uncertain future? And what does that do does that spiral us, or can we stop that? And it confuses the consumer, because they're saying, look, what I see, yes, I see gas prices high, but a lot of other parts of my life I feel pretty good about. But man, maybe I should be more worried than I am because of what Jamie Dimon and all these others are saying on Twitter or whatever. It's hard to tease that. It's hard to tease the sort of irrational from the rational right now.
Yeah. And then you have Tesla reporting. So Elon thought that, they really have solved their supply chain issues, and the second half of 2020 could be their largest production months ever. So you're definitely getting conflicting signals out of which company you're listening to.
Yeah. Well, we're in a transition, right? And so I guess it would be conflicting. We are definitely on one of those inflection points.
Yeah. And I think just simply management plays a role. Some managements are better at doing things than other managements are. Yeah,
including things like foreign exchange hedging too, and just thinking about the firms that are globally active. Are having to pay a lot more attention than they have had to over the last few years on how they're booking overseas profits.
Without a doubt.
Yeah.
You guys are far more the experts in this than I am. But when you think about, like, when you look at the housing market, and maybe this is kind of what you were saying, Brendan, is the fact that this was maybe just a bit of a correction, like a good way of putting it, rather than it's sort of some like massive ugly trend to come. Maybe we all those home prices and everything were like unrealistically inflated, and we're just getting back to some.
Yeah, I think it was a very unhealthy housing market, because you had the combination of the pandemic, which pushed people into buying houses in places that they really shouldn't have been. So kind of rural America was pretty stressed, and they just literally had no more houses. And a rich guy would pay $1 million for a house that should have been $250,000. So that was obviously very unhealthy. But every market in America was tight because we just didn't have enough supply, and mortgage rates were in the twos. So it was just really cheap to borrow and buy an extra house and figure it out down the road. People are now returning to the cities, which is that used to live in the cities. That's a great sign. And now mortgage rates, are up on high fives, low sixes. So it's much more expensive to buy a house, which gives us time and we're also seeing supply coming on the market. And of that supply, now about 20% has had to cut prices in order to try to sell it. Again, that was house prices just, they like doubled in a year in a pandemic, which we've talked about before. If you had given me all the information, but not told me what, to invest in, I would have invested very poorly knowing we were going to pandemic. I would have not predicted a housing boom.
Yeah. And what is the correction obviously is healthy. It's important to have. And I think that we've talked about this before on the show. When policymakers look at some of the high flying stocks that have really corrected and come down, that's actually reassuring to them in a lot of ways, because, a runaway upside market was something that was definitely, I can tell you for sure, worrying policymakers about, overheating of asset prices. This is an important correction, but how deep is the correction? And this is, it's all wrapped up in the Fed's reaction function. And one of the things that we know, obviously, is that Fed policy works with a lag. We're seeing it in mortgage activity, like really quickly. But in most of the economy, the expectation is that Fed tightening kind of has a 6 to 18 month lag. And when you look at the futures market is pricing in rate cuts next year. The futures market is saying the Fed is going to overshoot. They're going to oversteer into these curves. We're going to have a really bad economy. And then it's going to be, back from the brake to the gas next year. And that's a really challenging kind of picture for financial markets. It just is. It's hard to, if you assume that energy prices stay high because of the persistent, support from war in Ukraine and supply issues and that sort of stuff. Even if the economy really is sliding, can the Fed get into the rate cut business by like spring, summer next year in the face of like persistently high?
No, it's a really important point.
Very like peering out. I mean, dealing with the near term uncertainties is challenging enough. But like when you peer out into 2023 and squinting into the clouds in your crystal ball, it's really murky.
But the Fed is, I think, the markets right now are both simultaneously overpricing how high the Fed is going to raise rates, and then immediately overpricing how much the Fed is going to cut next year. And I think in the end, you get the Fed doing the middle. They don't hike as much as the market is priced in. Maybe we get to 3.25, and then they just stay on hold for a long time.
I thought markets were always rational.
No.
Is that not true? It's, by the way, on that note, GameStop stock split today too. Don't forget, you get that.
No, talking about the market. So Snap just reported earnings and they missed. A few quarters ago, when Snap reported earnings and missed, we were in, a market psyche that we were freaking out, and that drove the whole market down like 1% or 2% that day. Today, the market is behaving a little more rationally. Snap shares are down 30%, but they also realize that it's a small company that teenagers use and they don't use it anymore, and adults don't use it. So there's no read through to the broader economy.
Well,
that's having a hard time getting advertisers.
Well, I mean, when management at Snap is trying to read it through, they're like, it's not our fault. It's a bad economic backdrop. There's some platform changes and competition, but the first thing they listed in the accompanying commentary was bad macroeconomics, and that's hurting the ad spend. And I don't know, John Dick, are you seeing anything in terms of like the ad spend that these guys are talking about? It's infecting, the other sort of ad spend tech companies like Google and Facebook are down pre-market. As you say, Brandon, it's not spilling over to the rest of the market, but there is some question about advertisers.
Yeah, I mean, and again, I think it's really consistent with what we were saying earlier. Yes, it's happening, but it's happening more on a hedge against the future than it is, oh gosh, we're seeing terrible sales numbers and we have to cut costs. It's, we're planning for the worst, so we're going to scale back a little bit of this now, which is very different than the worst happened and now we cut back, right? So is this, are they jumping the shark a bit? I don't know. Maybe it's smart to sort of plan for the worst and hope for the best, but even the retailers, we're not seeing reduced retail spending. We're seeing smaller basket sizes, right? People are buying fewer goods, but paying more for the goods that they have. But the net for the retailer is still pretty resilient spending by the consumer. So their numbers aren't down such that should be triggering, reduced ad spend. It's one of those spends they can control. It's like how consumers, the first thing we cut when we feel or fear financial headwinds is going out to eat at restaurants, right? Because it's one of those few things that like doesn't feel mission critical to us in our lives. And advertising for a lot of these retailers is just that, because the CFO in these companies put tremendous pressure on the marketer to say, prove to me that these advertising dollars are working. And there's it's a multi-billion dollar industry trying to prove advertising attribution, and no one's ever perfected it. So it's just an easy thing for the CFO to say, oh, you know what, we're going to just cut this back a little bit because it's the one thing we can shave off, as opposed to like maybe laying off other people or cutting costs in other places. And it still just doesn't feel real to me. It feels a lot like these people are just getting ahead of something they think might happen in the future. And again, it's just very different than other times when we maybe in 08, 09, when we did see real kind of cutbacks in advertising spending because they had to do it. This is really a bet on the future, and obviously a bet on a negative future by the retailers.
Yeah. And going back to Tony's point about the news headlines, we love to just compare everything to something else. And I can't tell you how many times we're comparing this to like 08, like we're 2000, it's just not the case. This is a unique time where there are definitely some stresses in the economy, but there's also a lot of strength there.
I think about it like if I had a fever and I took a couple Advil and my fever started coming down, and then all the headlines would say, I'm headed inevitably for hypothermia, man, look at where it's going. It's like, guys, like, tap the brakes, right? Which is like, that's just kind of a good analogy for the economy, right? We're running a fever. The Fed, gave us some Advil.
Thanks to Twitter, I guess, or just the sort of how easy it is to whip up a website in your basement and become a blogger. There's almost like too many voices out there, and you only get everyone just loves to make their predictions, and some of them, obviously, again, the more gloomy and doomy ones tend to grab the most headlines, but. I want to go, if you don't mind, real quick. I want to go back to the housing discussion, because another thing that we're kind of watching, that and this is going to be a longer term thing and very sort of hypothetical, theoretical at this point. But it'll be really fascinating to see what this trend of like worker mobility will do to the housing market. When we survey consumers about their current jobs, there's a third of people will tell you that they live where they live because their job more or less requires them to live there, either because the employer literally does, or they feel like they have to be in proximity to a building they have to travel to. That's changing, right? It's already changed immensely. What does it do to the nationwide housing market when people can say, all right, I'm going to leave Seattle and move to Pittsburgh and buy a 2-acre plot of land with a 3,000 square foot house on it for 6 figures that I would pay $2 to $3 million for in Seattle? What does that start to do to kind of spread out does it kind of dissipate the concentration of the housing prices a bit, because the workers and the families have more options to pick up and move than they did before, right? If I have a job in Seattle and I have to stay in Seattle, I'm kind of screwed. I'm going to pay a high price no matter what. But if I can pick up and go somewhere else, where I can buy, a house for a third of the cost. We've never seen that happen before, and maybe it won't. Maybe I'm being, maybe it's too radical of an idea. But there's a lot of signal in what the consumer's saying about what kind of quality of life they want and their willingness to move from the place they are, that could change a lot of this stuff in ways we've never seen.
Yeah. I don't know. I mean, I do think it's just, I don't have good answers on it, or even, I feel like I'm just watching it along with everyone else, because it is such an unusual dynamic right now. But the labor mobility piece, just generally, sometimes I feel like I would love to do an entire show on labor mobility, because there's so much misunderstood about it. And even a couple of weeks ago, I read a really great research paper on the economic outcomes of immigrants in the United States. It was really fascinating. And what it showed was that because we have the opportunity for these longitudinal studies now, because of immigrants who came to the United States in the 50s and 40s, 50s, and 60s. And so we could do these studies on them and see what happens to them and their children and their success. And it's really fascinating, because the headlines, which are great for immigration proponents like me, because it showed that rather than being a drag on the economy or users of, public assistance programs and those kinds of things, the children of immigrants are actually they're more successful in the United States than domestic people. And a lot of us did a lot of storytelling about this over the years, saying, well, it's like there are things like selection bias. Well, these are the people who come from entrepreneurial stock, right? The kind of person who would cross the ocean without the language and come here to the United States. They're made of better stuff, right? They've chosen to go out there and be entrepreneurial and try things, and maybe there's some romantic storytelling to that. I'm coming from an immigrant family. I like to believe that. But what they found is the real differentiator between immigrants and domestic families is the attachment to their home region, where labor mobility for immigrants is wide, right? They can go anywhere they want in the country. They're not attached to, John, the Mon Valley, right? And how many of our people do we know who would never leave Clairton or McKeesport, no matter the jobs, because that's home. That's where they went to high school. That's where their family is. And it doesn't matter that there's a job in Arizona, they're not going. An immigrant comes, they don't have the same kind of attachment. And their family goes where the jobs are because they need to start working right away, and their kids are then generally in places where there are jobs. Now, it's true that they also try to go and take advantage of education and things like that too. So it's not completely, but the labor mobility part of it, I think, is just a really important factor. And all the storytelling that we in America did for years, comparing ourselves to Europe about labor mobility and the advantages of it, has been very powerful, but probably overstated, because of that feature of saying, we do have greater labor mobility in the United States than they do in Europe because they have, language and, stronger language and cultural challenges. It's easier for someone from Pittsburgh to fit in Atlanta than it is for a Southern Italian to fit in Frankfurt, for example.
Well, the UK kicked everybody out.
UK kicked everybody out. They didn't want labor mobility. They didn't want
the other really strong pro-immigration data right now is about. I mean, we had the slowest population growth in the history of our country last year.
Yeah.
We have an absolute population crisis. People aren't having nearly as many kids. The population's getting older, and we're over 2.5 million immigrants short of where we would have expected to be if the trajectory had continued since 2016.
But on the good side, our life expectancy is actually coming down.
Yes, yeah, that's the good news, I guess. But like you say, we're 2.5 million plus immigrants short in the population. You can't tell me, and all these other things, you can't tell me that's not a contributing factor to some of the workforce strains that
100%,
right? I
no
mean, it's
question.
Yeah, and like that's an easy like problem to diagnose, and frankly, not an incredibly difficult one to fix.
It's really only there are only two ways to fix it, and one is immigration, the other is procreation. But procreation takes a couple decades to pay off.
Yeah, and a few million Elon Musks having 10 kids out there.
That's
his father too.
So that's where we are.
Yeah, that's where we are.
Hey, what we wanted to switch to actually just looking at the global economy real quick, because we have, if we think of the three major global economic engines, the U.S., Europe, and China, U.S. is looking pretty good right now, isn't it? I mean, it's definitely the strongest engine. China has been with a lot of self-inflicted wounds, and Europe is just a tougher structural situation. It's not bad to be in the United States right now, right?
Yeah, although we did get some not so great news from the PMIs. The July manufacturing PMI was steady as she goes, a little bit of an upside surprise, slightly lower than the previous months. But the service PMI fell through the floor. It came in at 4. It just came out. It came in at 47. Expectation was for 53. For those playing at home, the PMI game is above 50 on a PMI denotes expansion in the sector. So 47 is like pretty steeply contractionary. Maybe it's an aberration, but that's a very steep decline in the services component.
That's really weird. I mean, I can't say that I have a good feel for the volatility in that print.
Yeah, it tends to be, the PMIs don't tend to be all that volatile. They tend to move pretty, I mean, they when there's a big phase shift. They do jerk, and they have big moves and big surprises like this. But the trend tends to be, these are trending indices, and the market. I think the market reaction is pretty telling. Equities don't care. This is part of the stock futures aren't going anywhere. Equity indexes are continuing to trade off earnings and so forth. The bond market, treasury market has been rallying over the last couple of days. Partly because European PMIs also came into the downside, pretty soft. Those were largely contractionary. Germany, France. And we had a couple of bright spots, but for the most part, it was all dipping into contractionary. That's an extension of the downward slide we've seen in these PMI indicators. But again, as we said before, this is intentionally inflicted, right? This is part of the solution, and it's sort of what it says. The Fed tightening, global monetary tightening, is doing what it says on the box, and slower growth is the path to ultimate rebalancing of the economy. So I think
John, are you saying
every number with a grain of salt is the right thing to do, but
I think freak out or don't freak out. That's what I'm trying.
I think don't freak out, and I think right now it's certainly too early to freak out. And when you look at equity markets, when you get a big downside surprise like this, the stock market's okay with it, and I think there are good reasons for that.
Yeah, and the dollar's weakening, that's the good news for U.S. corporate earnings, because as Tony mentioned, so much of our earnings come from abroad now. So, and the market was also relatively cheap, and the expectations were pretty low.
Yep.
And this also then goes back to the Fed. The Fed now has more and more reason to pause. So just as soon as the number came out, there's only a 2% chance now that the Fed hikes 100 basis points in July. So this is bad data is good to the sense that things are still okay, and it brings the Fed back from over tightening. If we have 3 more months of services in the negative contractionary space, then
I like negatory. I think that's
negatory.
I discorn your verbiation.
This is one topic that I really wish the consumer better understood. The U.S. consumer is just how much better it is here than everywhere. I mean, it just doesn't sink in. They don't care, but I wish they did, because there's so much chastising of Washington and the leadership and our economy and glooming and dooming. And it's like, if you could just take every American and send them on a field trip, fly them to London, have them rent a car and drive 30 miles to a Sainsbury and do a grocery trip and get a sense of how that feels compared to what it would be like doing the same thing here. And you realize,
try to get cable.
Yeah, right.
But I do think you're right, John. I'm sure it shows up a bit in your data that I do think politics plays a little bit of role in the negative view. I mean, our president's a very nice person, but he's 78 years old and hasn't really had a great plan where there was expectations, and it doesn't exude a huge amount of confidence even to Democrats, which I think seeps into overall negative sentiment.
Yeah, I mean, Tony and I've looked at this data a lot. I mean, if you cut our ESI by like political affiliation, it is incredibly highly correlated in terms of, and it was true under Trump too. Like it kind of flipped.
Yeah.
It was actually more, the gap was more severe under Trump because Republicans were far more optimistic than Democrats. Now, Democrats are more optimistic than Republicans, but the gap isn't nearly as large. But, our consumer confidence is absolutely an indicator of confidence in the political leadership to deal with the circumstances at hand. And that's clearly an issue right now, rational or not. But we also know that whether it's rational or not, it is changing behavior. To what extent we don't exactly know down to the dollar, but that sense of kind of we've conflated our political views and our economic views in ways that I don't think we used to do back, in James Carville era, right, when it was the economy stupid. Now it's kind of like a mashup of my political views and my real economic views. So
yeah, I think that's right. All right, guys. John, awesome to have you with us.
Always super, super fun. I learn a ton from you guys. This is great.
Oh, actually, Brendan, I forgot. What do we have? I can't remember next week.
Well, most importantly, we do have the Fed meeting next week.
We do have the Fed meeting next week. Absolutely.
Kind of
So
big.
that'll be obviously the big news of the market. So, I mean, as of right now, what is priced into the market is now no longer 100, any chance of 100 basis points raise, but 75 is fully priced in and expected.
Yeah.
We get second quarter GDP as well, and expectations are for a very modest expansion. But there's some, place your bets on that one. There's both, there's a wide dispersion of views, and we have a gauntlet of tech earnings. We've got Google, Microsoft, Apple, Amazon, Facebook, the murderer's row of the indexes. So, if there are some banana peels in there, we'll definitely feel it at an index level.
One last thing I reflect on was Netflix's earnings this past week or whatever, and they lost half as many subscribers as they said they were going to. But what's really fascinating in the streaming market, those consumers aren't dropping out of that market. They're just shifting. In fact, they're not even really cutting the only cost cutting that's happening in media and entertainment expenses is we've seen an acceleration of cord cutting, particularly among like rural middle Americans, right? And because it's a huge cost savings, right? But that's going to hit Comcast and Verizon and those people are moving into streaming. When we look at areas where consumers are cutting back and intending to cut back, streaming is almost like at the lowest end of that bucket, almost like a utility at this point. Like my television, don't touch my TV. So they're maybe leaving Netflix at $14.99 a month, and they're going and subscribing to 2 other services instead, where they don't have to sign up for a year and they can churn out as fast as they want. So even that isn't necessarily, we overreact to Netflix because they're the biggest kid on the block, but that money's just shifting somewhere else in the market. We're not seeing a reduction in the number of services people have by any means. In fact, on the contrary, it continues to grow. I have 4, I have 6, I have 8.
Yeah.
We kind of overreact again to those headlines as well. So
it's such a fascinating business because it's such a big share of how we get our entertainment right now, and the way it's shifting. You were like the Netflix news was interesting. We saw that earlier with Disney. But so everyone in that space, everyone from people delivering the pipes, delivering Wi-Fi to households, to all the content creators in that space. Some of the deals that we've seen recently, Microsoft buying getting into gaming. Microsoft's deal with Netflix on advertising is fascinating. There's just so much rich innovation going on in ways to entertain us and extract dollars from us that it's well worth paying attention to all the time. Yeah. All right, guys, great show, John.
Good stuff.
Wish I could get to a ball game with you. We need to try to plan for that.
Well, we still have a terminable season ahead of us. We're not making the playoffs, obviously, so we have to wait until like early October.
We'll get there.
So yeah,
We'll
all right. Good being with you guys. Thanks.
Thanks,
Have
guys.
a great weekend, guys.
Yep. Bye.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.